Hey, welcome into Investment Insight. My name is Hayden Proffitt. I'm the co-host of this. Alongside me, we have Brent McCay joining us today. So, Brent, how are you doing today?
Good. How are you doing today?
I'm doing great. So, the first topic that what we're going to kind of go over today is retirement accounts. That's something everybody wants to think about in our industry, right?
Sure.
They want to
Absolutely.
talk. It's one of the most. How often do we talk about that a week?
I don't know, maybe 5-6 times a day.
That's what I was fixing to say. Yeah, it's quite frequently. So, explain to me these three accounts, just in light of everything. 401k, 403b, and 457.
Sure.
These seem like alphanumeric accounts that, they add a letter onto it just to be a little more confusing with a few different stipulations, but just kind of give me a brief overview of those three.
So, of course, 401ks are what a lot of clients have. That's typically for your for-profit business. Most for-profit businesses have 401ks. They all kind of work functionally the same way in terms of they have a $22,500 contribution limit, either deferred or Roth. They have a catch-up of $7,500 that you can do a catch-up contribution to all three of the accounts. 403b tend to be more in the educational or the nonprofit sphere. They don't require as much testing as you know, Hayden, in your past life. There's not as much discrimination testing or accounting related to that. 457s tend to be government plans. So if you work for the state of Tennessee, if you work for the federal government, you tend to have a 457 plan. So those are some of the differences between 403bs and 401ks and 457s, but they're all very similar. You can do tax deferrability. You can also do Roth contributions in those. One of the things I know we're going to talk about today is one of the common questions we get is, should you do a Roth? Should you do a traditional IRA? And so it depends. So if you know for certain that you are going to make more money in retirement than you're making now in terms of income, you probably should look at the Roth, because the Roth, obviously, you put money in, you pay taxes on it now, all the growth and all the principal is then tax-free. So one of the common things people get confused about is they think when I put money in a Roth, does my interest grow tax-free? And it does. And so the biggest issue, though, is with a pre-tax account, the advantage is you put the money in now, you get a tax deduction today, and you get to take all that money you would have paid the IRS and earn interest over that for many, many years. Obviously your age does play a part in that. So if you're looking at the situation, we've got a really cool calculator where you can show the difference. But generally speaking, when we see people are projecting having more income in retirement or the same rate in retirement as now, we tend to recommend going to the Roth.
Yeah.
If they look like they're going to have less income in retirement, if you're 55 and haven't saved much for retirement and you're getting started, you might want to do the pre-tax, get that tax deduction now, because hey, you might be in a 22% tax bracket today and you might be in an 8 or 10% bracket in retirement. So why pay 22% taxes to only save 10% in retirement?
Yeah, you almost get like a tax break in retirement in that particular case.
Because many people, and what a lot of people don't think about is when you're working, you're paying into Social Security, you're paying for health care. You might have a mortgage in your house. A lot of people retire without a mortgage. They retire without having to pay Social Security taxes. And so a lot of people don't need as much income in retirement in order to replicate their standard of living when they retire.
That's awesome. So one thing I've seen with 401k specifically is the 401k match. Can you just explain a little bit of how that works?
Sure. So most employers, the typical average for most companies is about a 3% match. There are companies that do no match. There are companies that do higher matches. And what matching is basically is free money. A lot of employers will do a 50% match on, let's say, your first 6%. So it's a little confusing. 50% on 6%. Well, what that basically means is you put 6% of your paycheck in, they're going to give you 3% for free. So you're automatically getting a 50% return on your money. Now, one of the things that you have to be careful of is a lot of employers have started doing what's called true up 401k matches. And why this matters so much is, let's say you're a high flyer. Let's say, we got Hayden here and it's already, August, early August, and he goes in and he matches out, he already maxes out his account. So since it's not a true up account, it's just a regular match, he's already maxed out his 401k. He's already put the $22,500 in his 401k. Well, if he already does that, then that means the company doesn't have to match on any other income he has for the year. So by that, you put the money in, they're matching you by the paycheck, not based on your total salary. So if you made $100,000 this year, or you're going to make $100,000 this year, and you already matched out by August, and let's say you made 50, they're only going to match you on the 50. They're not going to match you on the full 100. So one of the things that we've noticed with a lot of major employers, especially in the Middle Tennessee area, is they've gotten really smart. And they're like, so you have one employee that makes 100, another employee makes 100, one employee gets a $3,000 match, and the other guy's getting a $1,500 match because he matches out early. So make sure when you're doing your matches in your 401k that you try to max out by the end of the year. And you got to think about this too. Like if you get a bonus, you do something really well in the year, you want to make sure that you kind of hit that in that last week or close of December. So you need to check those contributions. And some employers don't even allow you to change your percentage mid-year. So if you work for one of them, you got to plan even more accordingly. So that is one thing to factor in matches. But the cool thing about a match, the bottom line is saving for retirement is really critical because when you're getting free money, it makes it a lot easier to save.
Right. Yeah, for sure. And so we talked about the contribution limits. Let's say that I'm not 26. Let's say I'm 52, right? And I'm over 50.
Yeah.
Is there a way that I can save more at retirement?
Correct. So you have two options. As an employee, you can contribute $22,500. Anybody under the age of 50. At age 50, there's another $7,500 that you can contribute to your 401k. Also, your employer, with your contribution, which you put in, and the employer contribution, they can put all that together, cannot exceed $66,000. However, if you're self-employed, that opens up a window where you could, in effect, save $30,000 and put another $36,000 for yourself into your 401k through matching. And so that is where you can actually put up to $66,000 a year into a retirement account in 2023.
Wow. That's awesome.
Yeah.
So given the age thing, let's go to that another second. So we talked about 52, that I'm hypothetical. Now let's escalate 3 more years, 55, 59 and a half, and 72. What do those three numbers mean in terms of retirement? What does it mean in terms of, early withdrawals, everything like that? What does it mean exactly?
So a lot of people think that, hey, I got to retire at 65. And that's a common number out there too because that's when Medicare starts. And that is a good age for most people's plans when you're building a plan for retirement because when you have medical coverage, it makes it a heck of a lot easier to retire. But a 401k plans, if you retire where you're working, you are allowed to retire at 55 or a little bit older, and you can pull money out of your retirement account, and you will not have any penalties. You will have to pay taxes, but there's no penalties. There's a special stipulation within a 401k plan where you can pull money out at 55. Now that might mean that you might not bring the money into our office or with our practice or another practice. You might have to keep your funds with a 401k plan where you work. But the big benefit of that is if you wanted to retire early, you can pull money out at 55. Now 59 and a half is the most common age. That's actually, we call it here a little birthday here. At 59 and a half, you are allowed, even if you're still working in most plans, not all, most plans, you are allowed to roll that money from your 401k to an IRA. And that is a big deal there. Now 73, which is currently the age for required minimum distributions. A lot of people think of 70 and a half. 70 and a half was the age. It is now 73. At 73 years old, you are required by law to pull a certain percentage out of your account. If you do not do that, the penalty has been dropped. It was 50% last year. It is now 25% penalty. Now, there is an exclusion if you're like, well, hey, Brent, I didn't pull my RMD out last year. What can I do now? Well, you are allowed, if you fix it within 2 years, to drop that penalty down to 10%. But if you forget to pull the money out, you're going to pay a 25% penalty on that money in 2023. Another thing that is very beneficial for people to do is charitable deductions. A lot of people, when they give money to charity, they're not giving more. If you're married, you have to give more than the standard deduction. Well, if the standard deduction, is over $26,000, $27,000, if you're not giving $27,000 to charity, you cannot write that off on your taxes. So there's a special exclusion under the law now. If you are 70 and a half, not 73, if you are 70 and a half, you are allowed to give money out of your IRA to a charity, and it is not considered to be a taxable distribution. So let me phrase that again. So we got Hayden over here, he's an accountant, so it's a little easier for him to grasp it. So let's say, for instance, I want to give $10,000 to my church. What I could do is I can give the $10,000 to my church out of my IRA. I don't send the money to myself. I write the check directly from my IRA to the church. Because the check goes directly from my IRA to the church, I never touched it. I never had it. So it's not a distribution to me. It's now a distribution to my church. That, because I'm over 70 and a half in this example, is not considered taxable income. So if you look at your 1040, there's a line on there that says 1040 4A, 4B. 4A is how much you pull out of your IRA. 4B is how much is taxable. So now you get that $10,000. It's not taxable. You also get to take that standard deduction, and you get that $27,000 plus off being over 65. And so with both those together, by you giving that money out of your IRA, which I know we're not talking about IRAs as much on 401ks, but by you doing that, you can still do that for 401ks as well. By you doing that, you've now found a way to take an extra reduction of your income or reduce your taxable income by just figuring out how the money works.
That's awesome. Well, let's hit on the IRA just a second, comparatively to a 401k. Big difference here.
Yeah.
Beneficiaries. Hit on that, what the differences is with a beneficiary in an IRA versus a 401k.
So when it comes to beneficiaries, you can always, one of the easy ways to remember, 401k is a 4-letter word, an IRA is a 3-letter word. And so, one of the things that you look at there is, with a 401k, the employer makes the decision or has control of a lot of your beneficiary rules. So we've had a customer in the past, or several customers in the past, whose family members worked at companies and they had updated their beneficiaries, but the company had required a new update. They had not provided that update. When they did not provide that update, the company got to basically decide where the money went upon their death per state law. Well, in this one situation, we had a customer who had gotten cancer. He'd worked at the company. Well, he wasn't a customer. His brother was a customer. And he'd gotten cancer. He had submitted a beneficiary form where he wanted his 2 boys to be his beneficiary. Okay? Well, as it turned out, the company had asked for a new submission of a new form. He did not fill it out because he was getting treatment. He wasn't, he eventually died from cancer. Well, in that process, the company said his form didn't count. And because they had no submission, even though they had a signed, dated copy we had showing he submitted it, they got to make the decision. So they said all that money was now payable to his estate and not to his boys. Now, this matters a lot when it comes to beneficiaries. So beneficiaries under current law, if they're over the age of 18, they have the right to pull, when they inherit money, to pull it out over a 10-year period, not a 1-year period. When that company said that the estate was the beneficiary, all of that money had to come out of that 401k, and all of it was taxable. So in this instance, this gentleman, $400,000 of his life savings had to come out to payable to his estate upon his death. Estates are taxed at a higher tax rate than individuals. So after you get over like $14,000, $15,000, you're at a 37% tax rate for an estate. Now, it takes a married couple to get over $600,000 to hit that same rate later on. So think about that. That's $400,000 at 37% taxes.
Wow.
And so the benefits of having the money in IRA stands for individual retirement account. So that means the individual, you direct where your money goes. Not the company you work for, you direct. Now the benefits of that are, if that gentleman had named his 2 boys as his beneficiary, those boys, instead of it going through the estate process, instead of paying all those taxes, they would have 10 years to pull the money out. And here's the benefit too. it would have split over two people's tax returns, not one estate. And so then you get that money spread. Both children were in the military. They both had low incomes. So they would have paid almost no taxes on that money. And under the current rule, you can pick when in the 10 years, we're expecting some future guidance from the IRS. Right now, you can pick how much you pull out. So if you had a year where you had no income, pull out some extra money. If you have a year with high income, don't pull out as much money. And so you can really plan the taxes on that benefit. Now, the downside, of course, of a IRA over 401k is most of the time when you work with an advisor or when you hold money within an IRA, it's probably going to cost a little bit more money than with a 401k. You know, this company that we're talking about in this situation was a massive Fortune 500 company. They had multiple billions of dollars in their plan. So they're going to get a fee reduction. When you have $2 billion in a plan, you're going to get a better price than if you have $400,000 in a plan. And there's ways that, you know, we do business that help benefit through some trading and block trading stuff. But generally speaking, the downside of rolling a 401k over to an IRA is it might cost a little bit more money. So you need to be aware of what those costs are, what your options are. You know, obviously we'll have some future videos about why we feel like some things we do in our practice are beneficial for people, but that's up to the people to decide. What's next, Dave?
That's awesome. So let's hit this and we'll kind of wrap it up after this. But within the 401k, within the IRA, within all these different things, obviously they're comprised of investments, of stocks, sure, bonds, portfolios. Hit on this, and I'm gonna throw you a softball here with this one. But basically, how does risk play into it? How does risk play into stock selection, for one? What is rebalancing, and why does this matter to me?
Sure. So probably the most important thing that we've, you know, in 17 years I've been managing money for clients, and we've noticed is people don't look at their 401ks. They put the money in, market goes down. What do people do? They cover their eyes. They don't want to see it. You know, when the market's going up, everybody wants to look at it. And so one of the number one things you can do to help your portfolio out is rebalance your portfolio. You know, we all know that last year in 2022, the stock market was a little volatile. And many indexes at certain points were all in a bear market for the first time since the 70s. So you want to be buying some of those things that are cheap. This year's been a much different year so far. We're seeing the S&P getting close to that 20% number, and the bond market still being low. And so what happens is when the stock market goes up, you have stocks and bonds tend to be most people's portfolio. Most people's investments in the country are invested either real estate, stocks, or bonds. And so we all know that when the economy's going good, stocks and real estate tend to go up because when businesses make more money, they tend to pay their employees more money. And as soon as employees make more money, they want a bigger house, they want more land, they want more stuff. That's just a natural thing as we were built as humans. We want more. And so when the economy goes down, we realize maybe we don't need as much and we live on less. And so the value goes down. And so when you look at rebalancing a 401k, probably the number one thing that we feel like we can help people with, and we typically offer this service for customers at no cost, is if you move into some funds in your 401k that might be a little bit less costly, you can typically save on fees. So we like index funds. Index funds are very cheap. And the benefit of that is you're buying the whole market. So instead of you putting your money trying to bet that Google is better than Apple, just buy them all. Buy all the companies that are in that market. And so typically, you know, if Google artificial intelligence doesn't keep up, but Microsoft wins, which came out of nowhere about a year ago, you can see the two stocks. And you see Microsoft stock and you see Google stock not only performing. Well, if you own both, you won on the win.
And you also, with that, you kind of diversify too, don't
Correct.
you? So
That's
you're
right.
not putting all your eggs into just the Google basket per se.
Yeah.
They're not all sitting in one place. You got several different options.
That's a great point, Hayden. You know, when you're looking at diversification, you know, people want to reduce risk. This is your life savings. So if you're looking at having 502 or 503, the largest companies in the United States, if you own them all, in order for you to lose everything, every one of those companies you have to go out of business, which in that event is very unlikely there's something you can invest in that would provide safety if the event that every company in America that was of large size went out of business, because once the big ones went out of business, the smaller ones would follow suit. And so when we're looking at rebalancing, you know, if you said you had 50% stocks, 50% bonds, so 50% lower risk, 50% some higher risk. Market goes up 10%, bonds don't do anything. Well, now all of a sudden you're at 55% stocks, 45% bonds. So what rebalancing would do is we would take that 5% growth we made in stock market and we'd put it into lower risk bonds. That way, as the market's going up, you're moving less risky. When the market starts going down, you do the opposite. You start buying when it's lower. Because that way, when the markets recover, which historically they have, you're going to make some money. And so that rebalancing technique is a great way to lower your volatility, but it's also a great way to make some more money because you're buying stocks at lower prices, you're selling them at higher prices, and you're investing in assets that are more stable at higher prices and then preparing for the lower prices because it tends to be a seesaw. Typically when the stock market goes down, the bond market goes up. When the bond market goes down, the stock market goes up. That's why a lot of people will invest in a 50-50 portfolio because they're trying to reduce their risks.
That's awesome. Well, thank you so much for all the for coming in today and everything, and we look forward to seeing you next time. Thank you so much for joining us.
Thanks for seeing you. Have a great day.